Good afternoon, ladies and gentlemen, and welcome. We at Peerage and BMO are very excited for a fascinating interview with Douglas Porter. On behalf of all of us at Peerage, including our colleagues, employees, partners, and friends, we're enthusiastic to partner with BMO on this interview. Douglas Porter is an esteemed Chief Economist at BMO and a Managing Director. He has a fantastic resume, including his tenure at the Bank of Canada. And his involvement as the Chief Economist at BMO, he's involved in assessing macro trends and its impact on the economy, both in North America and globally, its impact on the stock market and various other industries, as per his role as Managing Director at BMO Financial Markets. We think that now is a very interesting time in light of all of the issues that the economy faces, the stock market faces, and the real estate industry. So without further ado, it's really a privilege and a pleasure to introduce Douglas Porter. Doug?
Thank you, Miles, and good afternoon, everyone. Thanks for having me today. Thanks for joining us today. So what I plan on doing is basically over the next 20 or 25 minutes is laying out a broad outlook on where we see the North American economy going, and then turning it around and showing what that might mean for various financial markets, and talk a little bit about the real estate market in particular. And then we're going to shift to a conversation between me and Miles, where we'll handle a number of very specific questions, and perhaps some questions from the audience as well. So if we could just start with the slideshow, please. If we could go to the first slide, please. If we could just turn to the next chart, please. So, unfortunately, I do have to start off with COVID. Of course, it is the dominant theme. It will continue to be the dominant theme for the economy. And what this chart looks at is basically just a rolling average of new cases in the U.S., Europe, and Canada. And it does look at it on what's pretty close to a per capita basis. So you can compare the three regions fairly readily. And I think the main message here is, after a pretty terrible second wave, we have seen right around the world the numbers come down fairly aggressively in recent weeks. Now, this could be a bit of a head fake. We did see the numbers coming down pretty notably late last year in Europe before they flared back up again, mostly in the UK at the start of the year. But it does seem like this is a bit more of a lasting pullback, and we're starting to see a similar decline in things like hospitalizations and mortality as well. Now, of course, there's plenty of concern out there about some of the variants. So, and I don't think we can completely let down our guard. But of course, the good news is we're starting to see the vaccine get rolled out in a much more significant way. And if we could just turn to the next slide, please. Just on that front, we have seen, despite a lot of criticisms and complaints in the U.S., the U.S. is actually among one of the world leaders now. They're now vaccinating more than 1.5 million people per day. It looks as if Canada will begin to pick up in a pretty meaningful fashion in the weeks ahead as well. And of course, we've got Israel and places like Chile that are way out there and leading the way, in the UK not that far behind. Before I go any further, I'll tell you what we're assuming in terms of when a significant majority of the adult population will be inoculated. Based on a number of different scenarios, the average of those views is we're assuming that more than 70% of the U.S. adult population will have a shot by June. And in Canada, we're assuming by September. Now, we could be, that could be overly cautious. It might be overly optimistic, but we think that's a pretty reasonable middle ground. And that's roughly when we think we can expect activity not to get back to normal, but at least be moving in that direction in both Canada and the U.S. If we turn to the next chart, please. Now, just in terms of the financial markets, of course, COVID is not through with us, but I would say the financial markets are through with COVID. They are looking 6, 12, 18 months down the line. They're looking well beyond the pandemic at this point. And it's not just the equity markets, which have been tested in recent days, but I would say they passed the test with pretty much flying colors. Famously, it's not just U.S. equities. Global equity markets actually reached an all-time high last year. We're even seeing markets as diverse as Japan's Japan's equity market actually reached its highest level in more than 30 years just in recent weeks. So this is quite broad, the rally that we are seeing in equity markets. But it's not just stock markets. Almost every financial market at this point is signaling a pretty solid recovery. And just one way to look at it is the chart on the right. Corporate bond spreads have completely reversed the damage that we saw last spring. By some measures, corporate spreads are actually lower than they were a year ago. And above and beyond that, commodity prices, and I think in some ways this is actually the most interesting development, that despite one of the deepest downturns that we've seen in many, many decades, commodity prices are actually now above where they were before the pandemic began. Even oil prices, they were one of the last ones to fully reverse the damage that we saw during the pandemic. But things like lumber prices, metal prices, they're at some like copper, for instance, are at their best level in years. Lumber prices actually in recent days have hit all-time highs. So this rebound in financial markets is actually quite broad-based, and it is signaling quite a formidable economic recovery in the coming year. Now let's see what we're calling for on that front. And if we could just turn to the next slide, please. So from a global perspective, the overall global economy fell by more than 3% last year. And just to put that in perspective, even during the intense recession of 2009, the global economy only fell by a couple tenths of a percent. So this was many orders of magnitude worse than what we went through in the very severe recession of 2009. It is the deepest global downturn that we've seen in the post-war era, and every single economy in the world was affected by it, everybody. Yes, there were a few economies that managed to see a little bit of growth last year, for instance, China. But even for China, a normal year for that country would be growth of about 6%. Last year, they grew by about 2%. So, even they went through what I would characterize as a recession. Then you step down the ladder there and you see, some other Eastern Asian economies were a little less hard hit. Then there's the U.S. Canada's roughly the middle of the pack. And then there are economies like India and the UK that fell by as much as 10% last year. Now, the good news is we're already coming out of those extreme lows. We're already setting up for a very powerful rebound in 2021. We believe the global economy will grow by somewhere between 5 to 6% this year and close to 5% next year. And just to put those numbers into some kind of context, a normal year for the global economy would be growth of about 3% or so. So this is quite a strong performance we're looking at for both this year and next year, well above what we would consider to be average for the global economy. So that's the very big picture view. Let's please turn to the next slide, please. From a bit closer to the ground level, for the North American economy, we saw about a 3.5% decline last year, and about a 5.5% drop in Canada. Again, the deepest drop of the post-war era for both economies. We do believe that both are setting up for very strong rebounds this year, even stronger in the U.S., despite the fact that they saw a somewhat lighter hit than Canada last year. Now, I do want to just address that issue for a moment. Why is it that the U.S. was less hard hit than Canada? I think there are two main reasons. One is that they went through less restraint, less restrictive measures than Canada did, and that's true even as we speak, that their lockdowns have been less intense than they have been in Canada. The other is partly the industrial structure of the U.S. They're much more dependent on the technology sector, which did exceedingly well, let's face it, during the pandemic, whereas we're much more dependent on the oil and gas industry, which went through incredibly challenging times last spring. Now, normally with a less hard hit, you'd expect Canada to be rebounding more heavily this year. That's not quite the case yet. We think that's more a story for 2022 and 23. We think we'll be playing catch up as we move into the outer years. But I think the main message I want to leave you with here is we are looking for pretty much a full reversal this year of the damage that we saw in both economies in 2020. By the way, that strength in the U.S. economy that we're looking at this year, that would actually be the fastest growth rate for the U.S. economy since the Reagan boom back in 1984. Turning to the next slide, please. Now, of course, with that deep downturn we saw, especially through the spring, the job market deteriorated very heavily. And I have to tell you that no other economy in the world other than Canada and the U.S. saw those massive increases in unemployment that we went through back in the spring. Now, the good news is those unemployment rates have come down. They've come down a lot, especially in the U.S. We expect them to fall quite a bit further over the next 18 months amid this relatively robust economic recovery. But we think that even by the end of 2022, we're still going to have an unemployment rate a bit higher than before the pandemic began in both Canada and the U.S. When you think about the sectors that have been especially affected, things like the restaurant, the hospitality industry, the travel industry, entertainment, those may not be the highest paid industries. They might not be the highest productivities industries, but they are very jobs intensive. They hire a lot of people, and it will take time. Even as people get back out, traveling again, dining in restaurants, it's going to take time for all of these restaurants to reopen. For somebody else, for those that are closed down, for someone else to step in. That's going to take time. It is going to take some time, even after things are back to normal, before the job market is completely back to normal. That's actually going to be one of the last areas that we think will fully recover. Now, the flip side of that is central bankers have basically told us that they're going to keep policy very, very easy until they think the job market has completely recovered. I'll get into this more in a minute, but the main message here is that we think policy will be super aggressively stimulative and for quite a period of time here until the labor market has pretty much fully healed. Next chart, please. Now, one thing that's very unusual about the cycle, and there's lots of things that have been very unusual about this economic cycle, but one thing that's really stood out is what's happened to household income during the cycle. Normally in a downturn, in a recession, you get a decline in household income. For instance, in 2009, in that year alone, U.S. household incomes fell by about 5% in 1 year. This time, not only did household income not fall in Canada or the U.S., it actually accelerated. It actually grew faster than it normally would. And there's no mystery what's going on here. This was simply due to the incredibly heavy amount of government support that we saw in both Canada and the U.S. At the same time as household incomes were rising faster than normal, households were constrained in what they could buy. They couldn't go to a restaurant in most cases. They couldn't travel. They couldn't go to a Maple Leaf game. And so they were constrained in what they could spend. And this wedge between rising incomes and constrained spending led to an explosion in personal savings. Before this all began, the typical Canadian household was saving about 3 cents on every dollar of take-home pay they were making. During the spring, it was more like 30 cents. The savings rate in both Canada and the U.S. got up close to 30% in the spring. Now, it's come down since then, but even as we speak, the savings rate in both Canada and the U.S. is in the double digits, well above where it was before the pandemic began. Now, we think the savings rate will come down over the next year, but the reality is this past savings over the past year has built up this huge stock of excess savings. We calculate that, when you estimate in what happened in the fourth quarter, we calculate that overall household savings above and beyond what they would normally be in Canada amounted to about $200 billion last year. That's about 10% of our economy. We think this represents just this enormous amount of pent-up demand that's just willing or waiting to be unleashed when people are able to spend again. We actually don't think that Canadians or Americans are going to need much prodding. We think that when they are able to spend again, they will spend. We really don't think it's going to take that much effort from governments to get Canadians and Americans spending again when they are able. Next chart, please. Now, of course, how did we pay for this? I mean, what's the flip side of this buildup, this tremendous buildup of household assets? Well, the flip side is we've had this enormous increase in government budget deficits almost everywhere. But I have to tell you, Canada has been pretty much a world leader on this front. A year ago, Ottawa thought its budget deficit was going to be about $30 billion. Or about 1% of GDP. Instead, it's going to be closer to $400 billion this year, about almost 18% of our economy. Now, a lot of this is just one-time spending that will roll off naturally as the economy reopens again. It's not going to be that painful because, a lot of the spending was basically just making people whole while the economy was shut. But there is going to be some lasting damage to the government's balance sheet. There's no question about it. And, of course, one of the more common questions I get is, how are we going to pay for this? Well, one way we are going to pay for it is that Ottawa's debt as a share of the economy will have taken one big step up. Before this began, it was about a third of the economy. After it settles down, we think it'll be more like between 50 to 60% of the economy. But we've seen worse. It was actually worse than that back in the bad old days of the mid-1990s. And something completely different from the mid-1990s is borrowing costs for the government are a fraction of what they were back then. So it is much more sustainable than it would have been, even 10 years ago, let alone 20 or 30 years ago. Having said that, it is very important that as the economy does recover, that we see these budget deficits come down and come down pretty aggressively in the years ahead. And I am anxiously awaiting Ottawa's budget, which will probably be out in late March or April, to see exactly what their plan is for the budget deficit in the years ahead. Next chart, please. Now, of course, it wasn't just fiscal policy. It wasn't just Ottawa's policy that changed dramatically and supported the economy and markets. Monetary policy rushed out the door as soon as the central banks knew we were in an emergency last March. They basically pulled out almost every tool in their toolbox. Both the Fed and the Bank of Canada immediately cut interest rates to zero. The Bank of Canada, for the first time ever, embarked on quantitative easing. They buy government bonds. They're still buying government bonds, $4 billion a week. That they're buying government bonds. In terms of the outlook, we think the Bank of Canada and the Federal Reserve have been very, very clear that if they make a mistake, it's that they'll keep rates too low for too long. So the very short-term interest rates that they can control, we think will remain at these current extremely low levels at least until 2023. Who knows? It could be even longer than that, but at this point, we think the most reasonable estimate is 2023 before they'll even start seriously consider raising interest rates. Now, those are just the very short-term interest rates. The longer-term interest rates have begun to creep higher in a fairly meaningful fashion in both Canada and the U.S. And Miles and I were just talking about this before we went live to air. One of the things that's changed in the last couple of weeks is the extent to which these 10-year bond yields have backed up, and they will begin to work their way into pushing up some longer-term mortgage rates in both Canada and the U.S., which have been at record lows as earlier this year. Now, our view is that to some extent the market is getting a bit ahead of itself. It's been, building in a bit too much growth, a bit too much inflation in recent weeks. We don't see this yield back up going a whole lot further through the rest of this year. But it is quite notable how quickly sentiment in the market has changed. And it's partly due to the view that the growth outlook is much better, and it's partly due to the view that inflation pressures are starting to rise somewhat. If we could turn to the next chart, please. And that has been an area of intense debate in recent days and recent weeks in financial markets among economists is what exactly is going to happen to inflation. Now, I said one of the more common questions I get is how are we going to pay for this? The other one I get is should I be worried about inflation? And I would tell you that the risks to inflation have risen. I think there's no doubt about it. Our underlying core view is that after the dust settles, the fog clears, a year or two from now, we suspect that underlying inflation of about 2% will reemerge. We still view that as the anchor around which we'll swirl in the years ahead. I still believe that when you're doing your planning, a reasonable plan is to base it on an average inflation rate of 2%. But I do see the upside risk to that as being more serious than I've seen for quite some time. There is a massive amount of stimulus. As I said, the Fed and the Bank of Canada, if they make a mistake, it's that they're going to stay at the party too long and keep policy too easy, too long, which will be tempting some inflation. We've seen even in recent days how there's some supply chain constraints building up, whether it's chips or, other bottlenecks that we're beginning to see build up and cause some specific price pressures. I mentioned record lumber prices. There are all kinds of instances of prices beginning to flare higher. But really, the key here is, does it lead to a big outbreak in wages? Unless and until you see wages also really begin to pick up in a meaningful and sustained fashion, I doubt any burst in inflation we're going to get will last. And by the way, make no mistake, in the next couple of months, we are going to get some pretty meaty inflation readings for a couple of months because it'll be compared to the extreme conditions of a year ago. I don't think that's that meaningful. What really matters is where inflation settles out 6-12 months from now. And as I said, we're still of the view that ultimately it will land somewhere close to 2%. Now, one area, and thanks for changing the slide, one area where we have seen a lot of inflation is in the housing area. I have to tell you, this is one area where forecasters just got it dead wrong. And even Canada's official housing agency, if you think back to just a little bit less than a year ago, was calling for an average house price decline of 9 to 18%. I think they got the sign wrong on that one because we've seen just the opposite. Whatever damage we saw during the spring shutdowns was more than reversed. This is way above and beyond a V-shaped recovery that we've seen in the housing market. The chart on the right, I call that my Canadian Football League chart. It's the 9 cities in the CFL It's the change in home prices over the last 12 months. This chart actually looks quite a bit similar to what it looked like a year ago. The only thing that's changed is every single city has taken a big step to the right. So in other words, the cities that were a bit weak a year ago, like Calgary and Edmonton, are less weak now. The cities that were strong, like Ottawa, Hamilton, Montreal, are even stronger now. Now, one feature I'd like to point out is Toronto is actually not an outlier at all. Toronto is actually pretty average. It's not average in terms of average prices, of course, but in terms of the kind of sales increases we've seen or the price increases we've seen, Toronto is actually fairly typical at this point. Where we're really seeing overheated or extremely strong markets are right up and down the 401 or the 400. It's basically, the smaller cities in Ontario, places like London, Ontario, like Windsor, like Barrie, like Belleville, Ontario. These places are seeing 30 to 40% price increases. And, there's a lot of different things going on here, but I think a few of the dominant factors are if people are just much more comfortable working from home, they're looking at some of the some of the perimeter cities. I also do think that there some new retirees are looking at relatively close cities, cashing in Toronto and moving out to some of these cities that are relatively nearby, but a fraction of the price of Toronto, and that is bidding up these markets aggressively. Looking ahead, we remain relatively constructive on the housing market. I have to say, if there's a spectrum of analysts, we've been pretty consistently, I would say, on the bullish side of the spectrum. Even we've been taken by surprise at how quickly and strongly the market came back everywhere. But if you turn to the next chart, in terms of our some of our big themes, we do think that the strength in some of these perimeter cities will remain. I think one of the more intense debates is we've seen this marked split between single-family homes and condos. It's actually one of the biggest gaps that there's been on record in terms of the rise in single-family home prices and in condo prices in the last year. I suspect that over the next year or two, some of that extreme gap does begin to reverse to some extent. I still do think that most of the trends we've seen do tend to favor the single family units for the next few years, at least over the medium term. But I think some of the extremes we've seen over the last year will tend to wane a little bit. If we turn to the next chart, please. Of course, one of the things that's weighing against the condo market, no question about it, is just basically the cessation of immigration that we've seen for obvious reasons. Last year's total immigrant numbers actually dropped by about 50% from the year before. I would just remind the kind of strong trend that we were on before this all began. One way to look at it is Canada's population grew by 1.5% in 2019. That doesn't sound like that high of a number, but in percent terms, that was actually the fastest population growth that we had seen in 30 years. In raw numbers, Canada's population had grown by more than 500,000 in the month of in 2019. That was actually one of the largest single-year increases ever in raw numbers. And of course, with immigration basically being shut off during 2020, the Liberal government has essentially signaled that they want to make up for those losses by increasing the targets in the years ahead. So when the gates do eventually start to open up again in a meaningful fashion, we think we're going to get another swell in population in the years ahead, and we think that will ultimately again narrow that gap that we've seen between the condo market and the single family market, because typically, of course, new immigrants do tend to be renters, not always, of course, but they do tend to be renters, and that will support the rental market in a very meaningful fashion. So we think, again, the main message I want to leave you with there is that extreme that we've seen, we think will begin to reverse. Now, another thing I did want to touch on briefly, just before I reach my concluding remarks. I came out with this piece about a month ago, and the Financial Post picked it up, where I talked about the housing market in general. But one fact I did point out is the average home prices in Canada are now, depending on exactly which measure you look at, are somewhere between 40 to 50% higher than they are in the U.S., even after adjusting for the exchange rate. And this, it's seemingly it's a fairly straightforward question. How is that? Why is that the case? Does that mean that Canada's, instantaneously in a bubble because, Canadian home prices are 40 to 50% higher than they are in the U.S.? And just to be clear, this is not, something that's always been in place. It's really only been a feature of about the last 5 to 10 years or so, where we've seen such an extreme gap open up between Canada and the U.S. And I think a fair question is, well, why is that the case? And I can pass on the link as to the full report, but a few of the factors that are behind this. One is, again, that strong population growth. Is definitely driving the demand side. There's no two ways about it. Even as Canada was seeing its strongest population growth rates in 30 years in 2019, the U.S. was actually seeing its slowest population growth in about a century in 2019. So we've definitely been going in very different directions in terms of population growth. And that's not been the norm, by the way. There was about a 30-year period where Canada and U.S. populations grew at almost the exact same percentage terms for, as I said, for 3 decades. And then we've had a very big split in recent years. There are some supply issues, no question about it. Especially in and around Toronto and Vancouver to a lesser extent. There's no doubt that supply constraints do play a role. I think also the fact that so many of overall house sales are in our 3 most expensive markets does tend to skew our numbers a little bit versus the U.S. But I also, and a fundamental point I made in my piece, is I also think that fundamentally Canadians just basically are willing to spend more on housing, and they value housing a bit more than their American counterparts. And I think this is a consumption decision that Canadians have made. And I don't think it's up to policymakers to try to necessarily squelch that. If that is a conscious decision that Canadians have made, that they want bigger houses, maybe more elaborate houses than Americans, and are willing to pay up for it. If that's a decision that consumers as a whole have made, and that seems to be the case, then I don't think there's that's necessarily an issue. So I think there are a lot of factors behind why Canadian home prices are above those in the U.S. Having said all that, I think to some extent this gap will narrow over the next 10 years, but some of that narrowing may be the fact that U.S. home prices might begin to accelerate a bit more. And one sort of underplayed story is just how strong the U.S. housing market has been in this recovery as well. We've seen some of the best U.S. house price gains in many, many years just in the last 12 months or so. And it's, driven by many of the same factors that we've seen in Canada. But I think it's very encouraging that we may be in the early days of a renewal of the U.S. housing market as well. And so that may be partly how some of this extreme gap between Canadian and U.S. home prices does get closed over the coming years by U.S. house prices playing a bit of catch up in the years ahead. And I would tell you, even with this run up in U.S. house prices, U.S. housing is still relatively affordable. I'm getting close to the end here. If we could just turn to the next slide here. One thing I did want to talk about very briefly is just the Canadian dollar. Much like many other markets, the Canadian dollar got hammered during the crisis last spring. It came back very quickly. It's now above where it was before the pandemic. It's close to 80 cents as we speak. That's actually the highest level it's been at in 3 years. And a lot of this, initially, it was driven by just a pullback in the U.S. dollar more broadly. We were moving in line with most other currencies. But more recently, the Canadian dollar has also been catching a pretty serious bid on this broad-based strength in commodity prices that I spoke about earlier. Our underlying view over the next years, we actually do believe the Canadian dollar is pretty close to fair value. We expect it to average about 80 cents over the next year. If anything, we think there's a bit of upside risk to that call. I'm not especially bullish on the Canadian dollar per se. We just believe that a lot of the global factors are very positive for the currency, whether it's a global economic recovery, the strength we've seen in commodity prices, or just some broad-based further softness in the U.S. dollar. We think all of those things will tend to be supportive of the Canadian dollar. If we could just turn to the next chart, please. And so just to conclude, I would characterize our forecast overall as being relatively upbeat. And by the way, just to clarify, we're not particularly that different from other forecasters in our views in terms of Canadian U.S. growth. I'd put us on the optimistic end of a fairly narrow spectrum. At this point, we're a little bit more upbeat than average on the U.S., a little bit more upbeat on Canada than some others, but we're not particularly different. For instance, the Bank of Canada is calling for 4% growth this year, and the consensus in the U.S. is close to 5%. So we're a little bit more optimistic than others, but not terribly out of bounds. And just in terms of the housing market, as I said, we do tend to come down on the constructive end of the spectrum. I think some of the extreme gains we've seen recently, or perhaps, we're not going to see those kind of gains be sustained for long, but we would remain relatively constructive on the Canadian housing sector. The two fundamental biggest drivers of the strength we've seen in recent years are very, very low borrowing rates, which we mostly think will stay in place, and very strong population growth, which we think will resume after the pandemic is over. So the two key building blocks for the housing sector will still be in place when the dust settles. And that's it for the formal part of the presentation. I'd like to welcome Miles back to conduct a Q&A. Thank you.
Terrific. Doug, that was extremely helpful and very informative and very provocative. I thought what I'd do is divide our questions into sort of two categories. One is macro issues, and then the other one is sort of micro issues, especially because a lot of our audience are real estate investors. So we'd like to focus on sort of micro issues pertaining to the real estate industry, both in Canada and the United States. So on a macro basis, if you had $100 to invest with a 5-year horizon, where do you think GDP growth is going to be more significant, Canada or the United States over a 5-year horizon?
So if we look back over the last 5, 10, 30 years, there has not been a significant difference between Canadian and U.S. growth. The differences do tend to even out fairly. Even when we've had stronger population growth, it's been offset by weaker productivity growth. So it's actually been astonishing how close Canadian U.S. growth has been. Over the next 5 years, as I said, I think we're going to be playing catch up a little bit with the U.S. So if you were to ask me for 1 year, I'd say the U.S. 5 years, I think Canada grows slightly faster because I think we're going to play catch up a bit. But I don't think there will be a huge difference at the end of the day. I think it's actually fairly close.
And economists have always said 3% GDP growth was a very good, expectation. Do you think both Canada and the United States over a 5-year period can sustain? I know you talked about 5% GDP growth in 2021, 5% probably in 2022, but looking out to sort of 2025, 2026, do you think 3% growth is a sustainable number?
Short answer is no. I think 2% is pretty close to what we can expect in this day and age. Now, and that's roughly what the trend was before the pandemic began in both Canada and the U.S. And by the way, there are official views from both the Bank of Canada and the Federal Reserve on what they believe is sort of the long run trend for growth, and both of them think it's a bit below 2% in Canada and the U.S. And that the two major building blocks of growth longer term are labor force growth, which is pretty close to population growth, and productivity growth. And in the U.S., it's split about down the middle, a little bit more productivity, a little less population. In Canada, the roles are reversed, a little bit better population, a little bit slower productivity, but we come out close to 2%. I am hopeful that there's a chance that it could be a bit better than that over the medium term. One thing that may have been triggered by the pandemic, if there's anything positive that might come out of this, is we have had a bit of a shock in terms of the usage of technology, and I am, whether it's on an individual basis or on an institutional basis, I am somewhat hopeful that, perhaps, we're using some of the technology that's at our disposal a little bit better. I am somewhat hopeful that we might get a bit better productivity growth, over the next 5 years than what we saw in the previous 5 years. So I'm hopeful I could be surprised a bit to the high side, but no, I think 2% is close to what we could expect over the medium term in both economies.
And one of the key drivers of the economy, of the market, has been low interest rates. We have had extremely low interest rates for a long period of time. I think the long bond was 142 or something yesterday. If you were to compare your expectation of bond yields and interest rates overall, looking out 5 years, do you think we back up 100 basis points, 200 basis points, 300 basis points? because obviously each bond yields differently. But relative to where we are today, what do you see happening over the next 3 to 5 years?
So funny enough, my answer would be slightly different than it was when we spoke a few weeks ago, because we have seen yields already back up quite a bit. But it would be between 1 to 2 percentage points from where we are, depending on the term. So, for instance, for 10-year bond yields, today, whether we talk about Canada, the U.S., or they're close to 130, 140 basis points, I would think they ultimately settle in somewhere around 2.25 to possibly 2.5%. So a bit less than 100 basis points or close to 100 basis points from here. For the overnight interest rates, the things that drive prime lending rates, we're for all intents and purposes at zero in both Canada and the U.S. right now. I think they get up to, when things get back to normal, which, fully normal could be 3, 4, 5 years down the line. I think we're looking at a short-term overnight rate of something close to 2% or a little bit below that. I'll just remind, in the last cycle, back in the good old days in 2018 and 2019, we were looking at one of the lowest unemployment rates in both Canada and the U.S. that we had seen in decades. We were looking at a fairly robust economy overall, and yet the highest the Bank of Canada could get its overnight lending rate in that very solid economic backdrop was 1.75%. And I would just use that as a reminder that that's as high as we could get in this environment. So, unless we're completely relying on inflation and inflation really becomes unhinged here, I think that's the kind of area that we'd be looking at over the medium term, and versus a quarter today. So that's 150 basis points for the short-term interest rates that we could see it climbing by over the next 3 to 5 years.
And in that regard, when you look at this, where is the inflection point where you see the backup of rates? So a 5-year mortgage was about 1.65% a month ago or something. Those rates are going up. At what point is there an inflection point where rates go higher and it affects the predisposition of the consumer to buy residential real estate? And is 200 basis points different?
Yeah, and so let's just to recap. I do believe that at the end of the day, interest rates are the single most important driver for the real estate market. Full stop. It has been behind this multi-decade strength that we've seen in home prices in North America, and especially in Toronto and Canada. And were we to have a serious change in the landscape on that front, that to me would be the biggest risk. And I'm often asked, what's going to bring down this housing market? I mean, what's ultimately going to do it? And the one thing that could do it would be a significant change in the interest rate environment. The Bank of Canada is well aware of that. They do not want to trigger a huge correction in the housing market. That's one of the last things they want to do. They'll be very mindful of that when it comes time to actually start raising interest rates, or even before that, when they start withdrawing some of their quantitative easing, some of their bond buying that they've done. The last thing they want to do, they want to see is rates start to spike up, especially if the economy is not completely recovered. But I do think, if say we had about 100 basis point rise in the 5-year yield, I think that would make a difference in the housing market. I'm not saying that's going to lead to a correction, but I think it would that would cap the strength that we've seen. I think that would be a very significant change if we had a 100 basis point move in 5-year rates.
So just taking that train of thinking, if you did have that, I mean, last year we had double-digit appreciation in value of transactions, volume times price, across North America. That obviously is not as sustainable. But if you were to look out 5 to 10 years, what do you think is a sustainable price appreciation expectation of housing? What do you think is a sustainable growth in volume? At Peerage, we've sort of used 3 to 5% volume and sort of 3 to 5% long-term, 5 to 10-year price appreciation. You think those are reasonable assumptions?
So if we were in normal times, I would say yes. I think that's very reasonable. People often compare home prices to inflation, and I don't think that's necessarily the right way to look at it. I tend to think of home prices versus overall incomes, or another way to think of it is nominal GDP or nominal income, and I think that actually tends to over time to be a better predictor or driver of home prices. Maybe a little bit less than that, but pretty close. And I happen to believe that longer term incomes will grow around 4% or so, or possibly a bit better than that. So yes, I think under normal circumstances, I would say assuming a price gain of 3 to 5% is about right. The one caution I would put out there is, we have, as you mentioned, we just came off an extreme period here, where we have seen, double-digit prices in many, many cities. And if you combine that with a backup of a potential backup of interest rates, I think there could be a period where we, we do go through a few years where prices don't rise by much on net. That is possible. But I think if you're talking about a long-term underlying assumption, it's not a bad assumption for prices. I can't speak to the volume side of that. I think based on history, I think that's actually fairly reasonable. That's within the ballpark of reasonable, I would say. So I wouldn't have a big challenge on either one of those. The one caution I would put out there is just thinking of the base that we're starting at for prices, and the likelihood that I wouldn't want to say rates have only got one way to go, but they're much more likely to rise over the next 5 years rather than recede further.
Janet Yellen said recently that her predisposition is to allow the economy to overheat to ensure that those less fortunate get some of the benefit of the fiscal stimulus going to the lower end of the economy. She'd sooner have an overheat than less. How do you feel about that? And what's the implication of an overheated economy?
And this is the message we're also getting from Jay Powell at the Fed. This is the message we're sort of more subtly getting from Tiff Macklem at the Bank of Canada. And to some extent, this this running the economy hot has almost been institutionalized in the Fed's policy now. Last summer, they changed their inflation target from 2% to an average of 2%. And it sounds like no change. It sounds very subtle. But because inflation's been running below 2% for quite a period of time here, if they're going to try to get average inflation rate of 2%, that means they're going to actually allow inflation to run a bit above 2% for a while before they actually even begin to raise interest rates. And so they are going to let the economy run hot. And that goes back to my earlier comment about there are some, meaningful upside risks to inflation at this point, because the Fed and now Janet Yellen is basically telling us that they want to run things a bit hot. Joe Biden, one of the first things he proposed was $1.9 trillion in stimulus. That is an amazingly large number, and it does look like the bulk of that is going to make its way through Congress. That is hugely supportive of the near-term outlook on the U.S. economy. That's also going to really put the U.S. economy into a pressure cooker. I do think that this has very big implications. That as I said, the official rates, the short-term rates, are going to stay very low for a long period of time here, even as the economy seems to be very hot, and even as inflation does temporarily get above 2% for a spell. It's a different world. Even in the last cycle, as we approached 2% inflation, the Fed started raising interest rates to calm the economy down. This time they'll be much more patient, and that's important.
I was told that on top of the $1.9 trillion stimulus, there's going to be a $2 trillion infrastructure spend. Do you think Canada will mirror that on top of its $400 billion stimulus, that they might put additional stimulus into the economy for infrastructure or other initiatives?
I think the Feds are taking a long, hard look at different infrastructure, and of course we've already seen the announcement on public transit that was wheeled out just the other week. Back in the fiscal update late last year, Finance Minister Freeland basically told us that she's keeping aside a kitty of $70 to $100 billion in terms of potential stimulus for the coming fiscal year, which starts on April the 1st, and the next two after it. And that's $100 billion combined over the 3 years. Presumably, they were probably front end load a fair bit of that money, and I suspect a lot of it will be going to infrastructure spending. Now, the reality is that in this country, it takes a long time to roll out infrastructure spending. I mean, you get these grand pronouncements, these big plans, and then it takes 5 years to actually get, or sometimes longer, to actually get out the door. But making an announcement is a big step in the right direction. And yes, I do think a lot of the focus will be on infrastructure. One quick note on the U.S. It's interesting. I think there's going to be quite a battle over proposed infrastructure spending. The view is that unlike the 1.9 trillion, that has to be offset somewhere else by either revenue raises or spending cuts. So it's not quite as clearly as stimulative as the 1.9 trillion package that Biden announced in terms of just pure spending.
When you did your forecast, I guess two questions. How did you assume a back to normal, quote unquote, sort of consumer spending environment post the pandemic? And what's the time frame of post-pandemic in your model showing in Canada? I mean, obviously, we've been behind in production of the vaccine, in distribution, in vaccinating people. Do you see most of the country vaccinated by year end? Is that part of your assumption in your economic model?
It is, and there's all kinds of different scenarios we've worked through. Vaccine hesitancy, if there's any potential bottlenecks, how bad if there is another wave because of the variants. We've worked through these, and we do believe that a significant majority of the adult population in the U.S. will be vaccinated by sometime around mid-June to late June. That's about 3/4 of the adult population, we think. And then almost all adults will be vaccinated over the summer in the U.S. In Canada, we think it's about a quarter behind, about a quarter slower. And also keep in mind that many fewer Canadians actually have any immunity because many fewer Canadians ultimately got the virus in the first place. So we are going to be behind the U.S. Our working assumption is around the end of September for a majority of the population, with pretty much everybody who wants a vaccine done by the end of the year. How soon do we get back to normal? That it depends, and I can't say we've got it exactly. As of October 15th or something. We're roughly assuming we're back to something close to normal by 2022. I would say we're flexible on that at this point. And by the way, just from a bigger picture, the economic models, a lot of people built up very, very fancy, sophisticated economic models over, the past 20, 30 years. They got blown out of the water by this event because they just can't handle things like, decisions by provincial governments in terms of when they're going to shut economies or, when they're going to, how and where they're going to shut retail economies. I mean, economic models just can't handle that kind of thing. So a lot of what you're seeing is just pure judgment these days by economists.
How sensitive are economic models of GDP growth to whether vaccination and herd immunity happens a month later, 2 months later, et cetera? Are they impacted significantly?
I would say if you're talking about a matter of months, it's not that significant a difference. I think when people see, the end is nigh, that we're right around the corner to getting back to normal, I think people will almost be operating as if normal, and certainly businesses will be significantly relieved. They'll be preparing for the reopening. You're going to see quite a bit better sentiment among small businesses, knowing that we're close. That people can start booking vacations again. People can start, expecting to go see the Toronto Maple Leafs in person again. I think that will really lead to a change in psychology, even if we're not completely able to get back to normal just yet. I think you will see things changing. And no, I don't think a month or two is going to make a huge amount of difference over the longer term. Having said that, it is very important that we get it right in terms of getting the vaccine out as soon as we can, making sure that we had obviously some logistical problems getting the vaccines. Now getting them in people's arms, it's incredibly important that we get the next step right and we get it done as quickly as possible, because every day that we're not back to normal, another business has got to shut its doors. They just can't hang on that much longer. So it is very important that we do get this process going as quickly as possible.
So Canada's been a big beneficiary of immigration. Pre-COVID, we were expecting around 500,000 immigrants to come to Canada. 2020, I think we had 200,000. I think I read that 1.2 million people would come to Canada over a 3-year period.
Yep.
once the borders get opened up again. Do you believe that that's a reasonable number? Could it be higher than that post-COVID? And what are the economic implications of that?
So it's interesting. In 2019, the population growth rate was well beyond, and what the immigration targets would have suggested. That there were a lot of temporary workers, a lot of foreign students who were coming to Canada. So it was above and beyond the official immigration targets that we're seeing. I actually do think we will probably, when we are able to bring in immigrants and under fairly normal circumstances, I think there is plenty of demand out there to come to Canada. I know there's been some concerns that we're going to face some competition from the U.S. Now that their immigration policy is likely to change very significantly under Mr. Biden. Yeah, there'll be a bit of competition maybe at the very high end for some super skilled potential immigrants, but I think there's just an enormous amount of demand globally to come to either Canada or the U.S., and the government will have no problem whatsoever, I believe, hitting their targets. If we need even more people, if we find we're in the blessed situation of being faced with labor shortages again at some point in the medium term, could they let in even more people? Yes, they could. I think this government is obviously very pro-immigration, quite clear. And so yes, I think it's we could even be surprised at the high side to some of the official targets that are out there in the medium term.
Canada is very dependent. Our economy is very dependent on oil prices. I think oil right now is around $63 or $64. Yes. What's your long-term prognosis for oil prices, and how does that affect economic growth in the country? Because I presume we've had a big spike in oil prices because of the Texas freeze, but that's a short-term aberration. It should come back down. And I think you said previously to me $55 was a reasonable number to assume. And how does that work in relation to supply demand and its impact in the west of Canada?
Yeah, and I actually do wonder if some of the spike that we've seen in the last couple of weeks is something above and beyond just what happened in Texas. That definitely pushed up prices. But it's interesting that Brent has gone to $65, $66 a barrel, and there's strength worldwide. Now, of course, the U.S. is such an important supplier that if they have a decline of 1 million barrels a day, that can actually have a very big impact on the global market. But yes, to your point, I think some of the strength we've seen in the last week or so is a bit overdone. Our working assumption is that West Texas Intermediate North American prices will average about $55 a barrel over the next year. I have to say I've been very impressed, amazed by the discipline of OPEC in the last 6 months or so. It's a world away from where we were a year ago. When the pandemic began last March, that very week, that we were shutting down the borders, closing down, that very week, Saudi Arabia and Russia decided to enter into a price war, just coincidentally. And that's what ultimately drove prices negative for a couple of days in April. But wow, we are a world away from that. When you think of the hit that oil demand is taking globally as a result of the stalling out of air travel, it is amazing that we were talking about $60 oil today. Because demand is still way below where it was a year ago, and people, frankly, still aren't driving as much, simply because of the commuting factor. So it's amazing that oil is as strong as it is. Very, very big positive for Alberta, by the way. I mean, Alberta's outlook has changed immensely in the last 6 months with this comeback in oil and other commodity prices that they produce. So I'm actually much more upbeat on Alberta than it would have been even 6 months ago. But to answer your question, yeah, we're still operating on the assumption that 55 is about the right price. If you look back at what an inflation-adjusted price for oil has been, like putting in today's dollars over the last 40 years, it's actually been about $57 a barrel. And I would aim a little bit lower than that, just because of the war on carbon that we're seeing, and the trend we're obviously going to see in the years ahead of people moving away or moving to electric vehicles, I should say. So I would tend to be on the under of that long-term oil price we've seen. But at the same time, there's incredibly fast-growing demand in places like China and India for oil as well, which tends to offset the pullback that we'll see in places like Europe and the U.S. So I'm still pretty comfortable with $55 a barrel.
The stock market's been a huge beneficiary of very low prices, for low rates, huge stimulus. The balance sheet of Americans gone from 50 trillion to 120 trillion dollars. Credit card debt is at an all-time low. Savings are at an all-time high. I think we're up something like 45% from the bottom in middle of May. If you were to look by year end, and I usually look at the S&P 500, are we up, down, or sideways by year end? And where do you think we are? Are we up, down, or sideways over the next 3 years from where we are today?
Yeah, so the two situations that are dangerous for the equity market is when you've got low inflation that's falling, or you've got above average inflation that's rising. Those are the two things those are the two big macro scenarios that are dangerous for equity markets. And of course, during the lockdown last spring, we definitely had the low and falling inflation outlook at that point. And of course, it didn't last long, but it was incredibly dangerous. The risk now looking ahead is that we do, again, this is what brings us back to that inflation concern is, if we do get too much of a good thing and we actually do get inflation above 3% that sticks, that's where it could become a real problem for the equity market. Generally speaking, we are still constructive on equities. We're cautious on some of the sectors that have done amazingly well over the last year. There are definitely two equity markets out there. There's the one that is showing signs of bubble-like tendencies. I don't have to name too many names there, but I can think of a few pretty obvious ones. And then there's the big sector of the equity market that I actually think is not overvalued, that still got some room to run. That will benefit from a global economic recovery, and I don't think that part of the market is overdone. Now, the S&P 500 has got a very heavy tech weighting, so that particular index I would be a tad cautious on by the end of this year. But if we're talking about global equity markets, the TSX, I still believe they're going to be higher by the end of this year. Not necessarily a huge gain from here, maybe a single digit gain from here, but I would still be relatively bullish on the equity markets as the global economy recovers. Looking medium term, I tend to be optimistic on equities. Of course you go through cycles, but unless the interest rate inflation environment completely changes on us, we're completely wrong. I would still be constructive on equities over the medium term as well.
So let's shift the conversation to real estate. Let's start first about your assumption of what back to work looks like and offices. Do you think that what are your assumptions about that, and what happens to office occupancy and values of office real estate, let's say in Canada?
So just as a background, I would just remind everybody that we had one of the strongest office markets ever in Toronto and Vancouver and Montreal before this all began. We had an incredibly tight market in a number of Canadian cities. Now, obviously the world has changed, but if we were, to completely go back to the way we were beforehand, we'd end up with an incredibly tight office market again in Ottawa and Vancouver and Montreal. I don't think we're going back there. I'm not going to try to tell you that my own situation is completely representative, but when I think of my own department, it's probably not that different from an average office in Toronto, and we're looking at moving to a model where maybe 15 to 20% of our time is spent working from home or out of the office. So we're looking to cut back about 15 to 20% of our space. That may be about representative. Some are talking about more than that. I just saw one big international bank today talking about cutting their space by 40%. You got some of the Facebooks and the Googles of the world, we're talking about completely working from home or something close to it. But then you've got others who it doesn't really make sense. It doesn't work that well. And I do think a hybrid model is probably about right. So it does mean we're going to go through a bit of a repricing in a sorting out in downtown office markets. I'm not maybe as bearish as some others, but there will be some repurposing and some resorting here. But again, I would just remind how tight things were before this all began, and it almost wasn't sustainable, the situation we were in before this this began.
Let's talk about residential. First, let's talk about immigration's impact on purpose-built rentals. So condo prices have fallen, let's say 10%. Rental rates have fallen. Airbnb rates have fallen. Mostly, we think, because of a decline in immigration of some 60% from expectation.
Yeah.
Obviously, post-pandemic, when there is herd immunity, the borders get opened up again. How long do you think it takes till rental rates and demand for purpose-built rental and condos go back to pre-pandemic levels?
So there will be a bit of a period where we're still going to be playing catch up with this backup in vacancy rates we've seen, and it's not entirely due to immigration. That's obviously the biggest part of the story, but we've probably also had a lot of people moving back in with mom and dad, can't afford to rent. I'm sure there's been a lot of that. Students who are at home instead of being at school now, doing it virtually. There's some of that. You mentioned Airbnb, because travel in general is all but dried up. It will take time. It will probably, again, we'll have to see exactly when the borders really do reopen again, but I would imagine it will take 2 to 3 years before we are, quote, back to normal, the way we were before. Now, that doesn't mean condo prices will fall for 2 to 3 years. And of course, investors will be ahead of that. They'll see the turn coming. But there will be some slack in the market, we believe, for a couple of years before things have really gotten back to normal on that front.
But there's never been, supply has always lagged demand in the condo and the apartment space. That's why all this purpose-built rental is still being built. And through the pandemic, obviously, there's been delays in construction. So if demand has gone down a bit, but supply's gone down dramatically because people couldn't build. So I thought there were supposed to be 35,000 units to be built in 2020, assuming no pandemic. But obviously that was probably half of that was actually constructed. And still, even today, they're still not back to full construction levels. How long do you think it takes till construction levels get back to where they were? And don't they have to be even greater to meet demand over the medium term?
You make an excellent point. I'm a believer that supply can actually, at least in terms of the building trades, can actually turn a bit faster than we're likely to see people actually coming back in a big way. But that is a debatable point. I admit. It's interesting. In recent months, Canadian housing starts have actually been enormously strong. In January alone, now some of this is is weather related, and you always have to be cautious about housing start numbers and around the turn of the year. But in January alone, we actually had one of the biggest monthly increases in housing one of the biggest monthly readings in housing starts that we've seen in decades in the month of January. So it seems to me, even with the constraints, it's actually amazing how things are getting done to some extent. But yeah, and for instance, again, not to bring it too close to home, but my own office floor is being renovated, and it was was basically put on hold by the latest round of restrictions around the turn of the year. So yeah, definitely there will be some hiccups, but I think that will end as Toronto starts to reopen, and I'm assuming we're not going to go through another lockdown like we just went through. So I believe supply can actually get a little bit ahead of demand here for the next year.
In residential real estate, it appears that the biggest beneficiary of the incremental demand has been suburban. Do you think there's a permanent change to the psychology of the real estate buyer toward wanting a backyard, a basement, and more space, and that's why the 905 and other areas, 705, have been big beneficiaries of this? And do you think it's a permanent change, or do you think it's just a resetting because values were in the suburban market were much lower in proportion to what condo prices are, and then now there's an evening of that opportunity.
So I have to say I'm very cautious about assuming anything that we've seen in the last year is going to be permanent. I mean, some things will be. Of course, I think we've had a level change on things like online shopping, for instance. I don't think it's going to stay at the kind of levels that we've seen, but people have obviously become much more comfortable on that front. So on things like the shift to suburban, I'm a bit cautious whether that's permanent or not. We're actually putting out a report this week on, the outlook for cities in general, and the extent to which they're going to continue to be drivers of economic activity in Canada. And our one of our core conclusions is, when we look over 5 to 10 years, we still think cities are going to be where it's at, and that the pandemic is not going to change that. That city, the big cities will still be the engines. There's still going to be a lot of demand to be in the downtown core, as especially to live in the downtown core. I also think some of what we've seen in the last year, it is partly demographic. I mean, there were a lot of people of a certain age who are living in condos who would have moved out in any event out to the suburbs as they were starting to have kids, and would have made that move in any event. But having said all that, I do think there may have been a subtle shift that could stick. People could see, if you don't have to commute every day, if in fact you're allowed to work from home in the future, and you don't have to get on a GO train or get it on the on the Queenie W every day, then suddenly living out in where I do, out in the West End, whether it's Mississauga or Oakville or Burlington, suddenly doesn't look so bad anymore. One of the biggest gains we've seen in the GTA is in Oshawa home prices. Suddenly places like that and what look like a formidable commute don't look so bad. So I do suspect that some of this could be permanent. Yes.
And is there a psychological level, like house prices in Toronto on average are approaching $1 million? And 5 years ago, you would have said, well, if it gets to $1 million, that's a bubble. Is there any value? Is there any substance to the issue that says $1 million is really a psychological level, or that's not true? And the second thing is, I keep getting people saying to me, are you sure it's not a bubble? Are you sure it's not a bubble? So what do you say to people, A, about $1 million, and B, about a bubble?
So I think on an individual basis, I think $1 million matters. I think as an average, it's more abstract. And, just because the average hits $1 million doesn't necessarily mean anything in particular. I mean, Vancouver's been above that many, many times. So, and, it didn't lead to an instantaneous popping of Vancouver. So I don't think there's anything magical about it as an average number. In terms of a bubble, of course, that's, to some extent, a bubble's in the eye of the beholder. In the last 20 years, I've called one bubble on the Toronto housing market, and that's when we were frenzied in early 2017. And we were, there are bubbles, and then there are bubbles. And I would say we were in a little bubble at that point. And the steps that the Ontario government took at that time, I'm probably not going to win any friends here, but I was actually somewhat supportive of, because I think it caught it before it got into a dangerous territory. It caught it, and it brought it down and didn't lead to outsized pain for the broader economy. Actually, Bank of Canada Governor Tiff Macklem was just asked this question yesterday in so many words. Does he believe we're in a bubble? And he said there were signs of exuberance, but we're not back to the situation we were in 2016, 2017 yet, which to me meant he was basically saying no, not yet. I would tend to concur with that. But there are warning signs that are starting to creep up. It does concern me when I see places like, prices in London, Ontario going up 40%, Woodstock, Ontario going up 35% in a single year. So I know the Windsor market relatively well. My wife is from Windsor. My dad was from Windsor. I'm actually from London, Ontario myself. Windsor prices have absolutely screamed higher in the last couple of years, and there's nothing in the economy in Windsor, Ontario to support that kind of a move. I mean, some of it is retirees moving in from other areas and saying, wow, this place is cheap. But it's starting to build on itself a little bit. Like, you can almost see the fear of missing out really taking hold in places like Windsor, and I'm sure it's going on in other markets as well. And that does concern me a little bit. I think that's where you get into, where you can actually start talking about a bubble where people are chasing it just because they believe that they have to get in, before prices go up another 10 or 20%. I don't believe we're there broadly in Toronto or nationally, but there are some warning signals out there. So long way of saying no, I don't believe nationally or in Toronto we're in a bubble, but it's getting into sort of the yellow zone in my book.
Last question. How are we going to pay for all the stimulus? How worried are you for your children, your grandchildren? We've created all this. Obviously, got to have an increase in taxes at some point in time. How worried are you about, how this all comes home to roost?
So I'm worried about it if we don't see the deficit start to come down in a very rapid fashion as the economy reopens. I'm a bit concerned about how casual the federal government is in particular about the kind of deficits they're running, and how quickly they're spending $10 billion at the drop of a hat. Friday afternoon, the Prime Minister announced that they're extending the CRB, which is sort of Sir Blight. And oh, by the way, that's going to add on an extra $12.5 billion to the deficit. In the old days, $12.5 billion was an enormous amount of money. That would have been 3 major programs. And, something like that's announced on a Friday night. I get why they had to support the economy so much, but we were world leaders on that front. Like we did as much as anybody in terms of supporting the economy. So I think I'm not saying that was wrong. I'm just saying we have to make sure that was temporary and it comes down pretty quickly. And the backup in interest rates, long-term interest rates we've seen in the last 2 months or so just shows us there's no free lunch here. This was something we could do for 1 year. But it can't go on if as the economy recovers. I push back a bit on taxes have to go up. I think I think the way we're going to pay for this is we've taken on a lot of debt, and that debt's going to be with us basically. If I was finance minister, I would not do anything with taxes for the next few years. Wait until the economy is completely recovered. The best cure for the budget deficit is to get an economic recovery. If we still find that revenues are well short of expenditure, 2 to 3 years when we're hopefully back to normal, then I might start to at least look at some of my revenue options. But until then, I would not be even talking about tax increases. Of course, they're going to pick a few things like the Netflix tax, or they've talked about taxing non-residents who have vacant homes. But by the way, that's a very interesting element they picked out in the financial statement late last year. But I'm not that convinced that we necessarily have to crank taxes in a serious way to pay for this. I think an economic recovery is really the best cure for the deficit.
Doug, thank you so much. On behalf of all of Peerage's colleagues, partners, employees, and friends, and our esteemed partners and colleagues at BMO, especially Jeff Burden and Steve Jensen for facilitating this, you have been extremely informative, very insightful, and you've provided a perspective on a very complex set of dynamics at a very important time. So all of us articulate our appreciation and gratitude for this. We will make this recording available. If anyone would like it, we'll post it on the Peerage website. But also, if you'd like it, just send us an email to the invitation that you received, and we are happy to send it. A number of people expressed an interest. We had great demand to be on here today, but incrementally we had a number of people who expressed the desire to hear this but weren't able to be here. So on behalf of all of us, thank you very much. Thank you again for making yourself available. Thank you for your kindness of participating with us, and we look forward to speaking with you soon, and we wish everybody a healthy and joyous 2021. Thank you again, Doug.
Thank you, Mas. Bye, everyone.
Take care.